you still have to pay the utility bills, not be at the office as a main provider, but you still need a manager to answer the phone calls and so on and so forth. So fixed costs are expenses that you have to pay regardless of any production in the dental practice.
What are the biggest fixed costs in most of the dental practices?
The biggest fixed cost typically is rent.
Why are high fixed costs risky?
If you have a high fixed cost, what happens is
What's the difference between fixed and variable costs in a dental practice?
so fixed costs are essentially costs that you have to pay regardless of any production. So it doesn't matter if your dental practice was open for the whole month or not, you still have to pay rent, okay? You still have to pay the utility bills. You may not be at the office as a main provider, but you still need a manager to answer the phone calls and so on and so forth. So fixed costs are expenses that you have to pay regardless of any production in the dental practice.
Okay.
Variable costs are costs that are only incurred if you have production, okay? Only if you're producing dentistry. So for example, when you're providing services, you need dental supplies, okay? You might need lab expenses, okay? Those are the two main variable costs. Now, variable costs in dental practice also includes payroll. So payroll is in both fixed and variable, because as fixed, you need to have a manager, you need to have somebody answering the phone, okay? So that's the fixed part of it. But then you need to have dental assistants. So typically, a dentist will have at least one dental assistant, but as you grow, you might get a hygienist. As your hygiene department grows, you might have multiple hygienists. So that part of the cost is actually variable. If you get an associate, it's again variable, because if the associate produces dentistry, then they get paid. If they don't produce dentistry, they don't get paid. So that part is variable. So payroll costs in the business of dentistry is somewhat fixed. Some of it is fixed, some of it is variable. Then there's merchant service charges, which is not that big of a charge, but those are typically the fixed costs and the variable costs in a dental practice.
Okay. But why does understanding the difference between the two matters?
If you know your fixed costs, you know that, okay, regardless of what happens, I have to pay this, okay? So you kind of sort of get, okay, I need to produce X number of dollars so that I can pay my bills that are fixed. Look at this with an example. So if you're paying $10,000 in rent, $500 in utilities, you're paying $2,000 to your front desk person, you add all those costs and know that at least I have to produce, or I have to collect $12,500 so that I can pay my fixed cost. That is not the whole extent of it, but I'm just giving you a small example. So you need to know what your fixed costs are so that you can keep that in your back of your mind that, okay, these are the things I really need to pay. You will need to pay if you have a staff member who might be variable cost, you still need to pay them as well. But it gives you a pretty good idea how much money do you need each month.
What are the biggest fixed costs in most of the dental practices?
The biggest fixed cost typically is rent.
Okay.
So that is typically the biggest fixed cost. The other one is probably the front desk person you need each, for your dental practice to answer the phone calls and make appointments or do billing part of it. So those two might be the two biggest fixed costs in a dental practice.
Okay. And why are high fixed costs risky?
If you have a high fixed cost, what happens is it is harder to make a dental practice profitable. So let's say you have two dental practices. Practice one has $3,000 in rent, practice two has $10,000 in rent. Now, for practice one, that's the fixed cost. That's one of the biggest fixed costs. So if the dentist produces $3,000 that month, that covers that cost. Now, for practice B, they have to collect at least $10,000 before the doctor makes any money and makes any money to pay other costs. So what happens is the bigger the fixed costs, you need to get to that number first, and then you need to pay other expenses as well to churn out a profit. What really happens is if you have a $10,000 facilities expense cost, that's just the rent. And then the average of facilities expense is 8.59%. So you have to figure out, okay, what is $10,000 divided by 8.59%? And that is the number you have to read to bring that percentage in line, get to the average. EBITDA of 35.22%. Okay. So it gets harder to get to the 35.22% if your fixed costs are high.
Can payroll be considered fixed?
Payroll is fixed and variable in a dental practice. As I mentioned before, you have to have certain employees at your dental office so that you can do billing, somebody needs to answer the phone call, and so on and so forth. Almost all dentists have a dental assistant, so you might have two people. Typically, if I'm working with a startup dentist, I encourage them to get an employee who can do dental assistant work and the management side of it, who can answer phone calls for you. That way, in the initial stage, you're not spending money on two different employees. Hopefully, it's just one employee and the payroll is a little bit lower. It just saves you a few dollars when you're just starting out. Eventually, those two are full-time positions, so you will eventually have an office manager and you will obviously have another dental assistant or more.
Okay, now coming to the variable costs. What truly are the variable costs in a dental practice?
Variable costs are costs like dental supplies, lab expenses, hygienists. If you have associate doctors, those are all variable costs. As you produce more, you need a doctor to produce more. So as that doctor is producing more, there's more going to that doctor's payroll. I'm talking about an associate doctor. The hope is that, okay, if you hire a hygienist, she's going to be producing 3 times of whatever she's getting paid. So hopefully when you hire a hygienist, she is going to produce 3 times her wages. And hence, when you hire another one, then you have more hygiene wages, but then the production goes higher too. So it's all related. More employees hopefully convert to more production and hence more collections and more income for you as the owner doctor.
So, why are variable costs healthier when it comes to the growing phase of a dental practice?
The practice grows as these new employees produce more. So they get in there, they produce more dentistry, be it the hygienist or the associate and the assistants helping them. As they produce more dentistry, your top line revenue looks good and hence you are making more money.
How do fixed cost impacts the expansion decisions?
Well, fixed costs have a very strong impact on expansions. If you're a dental practice already in a location and you feel like we're at capacity at that location, and if something opens right next to you and you're like, okay, I want to take over that space. So you're going to either, let's just say you're going to double up your space, okay? So if you're going that expansion route, then you're going to have to pay rent for an additional unit. It's not a monthly, it's not a one-time thing. It's an ongoing thing. You will sign a lease. So there's a lot of fixed costs in that. Plus, you're going to have to invest quite a bit on leasehold improvement. So you might get a loan to do that. And then obviously you'll have to add equipment. All of these things end up where you're committing yourself to paying additional dollars each month. So you have to be really, really careful and do analysis that, okay, is the expansion going to help? Should I really do it? Or can I just produce the same amount in the space I have? I just recently talked to a client. The idea was that they were going to expand into the shop next. Initially, it seemed like it was a good idea, but when they looked at the numbers closely, they could produce a lot more dentistry in the same current office, and they did not really need to expand into the next office. And even if they could, right now is not the right time. Okay, so when you start looking at the fixed costs, you're like, okay, do I really want to spend those dollars? When people get into the expansion mindset, I feel like people are excited and sometimes an emotional decision. Fixed costs bring the reality right in front of you so that you can be like, okay, do I really want to spend all these dollars? Am I really going to have a return on investment on this money? So you really need to look at the fixed cost before you expand your current dental practice. And that's the same with, if you want to open a second location, how are you going to handle that? Again, you're committing to a lot of money. You're committing to paying rent for a certain number of years. You're going to have to do leasehold improvements. So all of those costs do matter. And then you need to keep in mind that, okay, initially, maybe my current dental practice or the new dental practice is not going to be able to support all those payments. How am I going to absorb those fixed costs? Is my current dental practice going to support that? Or when I'm getting the loan, I'm going to get an additional $100,000 to get the new practice going? What is going to be the scenario?
Okay. And in what more cases can growth become financially dangerous for a dental practice?
I mean, let's just look at the example I was giving to you. If this client had actually moved on and occupied that space, that's a lot of cash going out of your pocket. In most cases, what really happens in the dental industry is like they will survive. Dental practices are fairly resilient businesses. So most dentists will survive the impact, but then they're not happy about it. It's a bad decision. You moved into that. Even though it's not helping you from any angle, you're still having to pay those expenses, and it's a very expensive mistake.
Okay. So how should they evaluate the new expenses?
I would write it down. I mean, put it in an Excel file that, okay, hey, here are all the costs that I'm going to incur if I'm expanding. What are the things that I'm going to have to pay on a monthly basis? Loan payments, rent. If it's a location that is separate from your current dental practice, then you need an employee over there. So look at all those expenses and figure out, okay, hey, I need to produce or I need to collect at least X number of dollars so that this new location pays for itself. It's not just expansion, but even when you're starting a new practice, hopefully most dentists go through that scenario and are like, okay, I'm opening a dental practice, minimum expenses that I have to pay. And then in the back of their mind, they think about that, okay, I need to collect at least $12,000 a month so that I can pay the expenses for the dental practice and not have to put money from my own pocket. There is the opportunity cost that, okay, you were working somewhere else. If you want to take that into consideration, then obviously you have to produce more. But at least from a fixed cost standpoint for a new startup, you need to think about, okay, what's my rent? What are all the other expenses I have to pay? And it tells you a number so that you can be cognizant when you are starting your own new dental practice or expanding.
What's a good, healthy way to balance the fixed and variable costs?
I mean, I think at the end of the day, you have to look at expenses from percentage standpoint. You have to compare those to benchmarks. That's how you have to look at them. Average for a general dental practice on payroll is 31%. Are you close to that? On an average, spends about 5.86% on lab. Are you close to that? So I would look at those percentages and focus on those and compare your dental practice to those averages and see where you lie. And if you're way above that, then you need to figure out how do you come back. Those are based on variable costs, okay? From a fixed cost standpoint, for example, facilities expense, that's a fixed number. Every month you have to pay rent. Every month you have to pay utilities. If the ratio you're coming up for your dental practice is 15%, you're spending 15% of your collections on facilities expense, the only way to fix that or bring that down to the average of 8.59% is increase collections, because that number does not change. The only way to bring that the percentage down is to increase collections. As you increase collections, that number starts to come down, and eventually it will come down to the 8.59%. Here's the great part. If you have a dental practice, if you start to produce like $2 million, $3 million, that number for the facilities expense still stays at $17,000. Let's make it simpler. If the facilities expense is $10,000 and you're producing $1 million, that means you're spending 10% of your collections on facilities expense. Now, let's say if it goes from $1 million to $2 million, facilities expense still stay at $10,000. There's no additional rent because you're producing more,
right,
and collecting more. That still remains the same. So what happens is that number, that percentage goes down to 5% in this case, $2 million to $10,000. So you really have to start looking at that and be like, okay, what can I do and how can I increase the collection of my practice without really expanding or opening a new location. What can I do to get the maximum out of my current situation, my current location? Sometimes it is increasing the number of hours. Sometimes it is opening on the weekend. You just got to figure out what works for you and how you can get the most amount of collections in the same space.
How does reviewing your monthly finances help in managing this?
Well, when you review your monthly financial statements and compare them to benchmarks, what happens is you get to figure out, okay, how am I doing from a variable expense standpoint? Employee expenses, dental supplies, lab expenses, merchant services. Am I staying close to the benchmarks or am I going further than that? If you are at 31% and you move to 35%, then that means your profitability has gone down. You need to stay at the 31% or become cheaper. Same thing with dental supplies and lab costs. When it comes to facilities expense, that number can only be changed by the collections increasing, and as those increase, your numbers for the facilities expense comes in line. And if you produce high enough, goes way below the 8.59 average percentage.
What's one financial concept that every dental practice owner must understand deeply?
Every dental practice owner should know that, okay, hey, I have to have a certain amount of income so that I can pay my bills in the dental practice, okay, without having to put money from my own pocket. So figure out what your fixed costs are and make sure you're collecting at least that much. I mean, that is not the goal of a dental practice. The goal of the dental practice is to make more and more money so that you have a healthy profit in the dental practice. But in the beginning, that's what you have to do, is figure out how much money do I need each month so that I can pay all my bills and not have to put money from my own pocket into the dental practice. After that, to really be more profitable, you need to make sure you're looking at your percentages. How much money am I spending on payroll? What percentage am I spending on payroll? What percentage am I spending on dental supplies? Because those are the categories that you can actually control. How much am I spending on lab costs? Those are the three categories that you can really control and figure out, okay, I'm going to make sure I am not overspending on these.
So once again, DJ, thank you so much for coming on the podcast and sharing such valuable information with our audience. And if you like this conversation, do subscribe to the channel. Thank you.
Thank you.